Welcome to ICAN Academy YouTube channel. In this lecture, I want to examine rollover relief in capital gains tax computation. If you are coming across my lecture for the first time, please like the video, share it with others, and subscribe so that you don't miss my upcoming videos. Thanks for watching ICAN. So what do you mean by rollover relief? Rollover relief is granted where the sales process on the disposal of certain chargeable assets is utilized in the acquisition of a new asset of the same class. Rollover relief is granted where the sales process on the disposal of certain chargeable assets is utilized in the acquisition of a new asset of the same class. That is rollover relief. That means the asset upon which rollover relief can be granted must be of the same class. That is, if a building is sold, then if you want to claim a rollover relief, that proceeds from the sales of building must be reinvested in another building. Not to sell building and buy motor. No, they are not of the same class. If you sell motor vehicles, you utilize the proceeds to acquire furniture. They are not of the same class, so you can't claim rollover relief on that. Rollover relief is granted if the consideration received on the disposal of an old asset for the purpose of trade is applied in acquiring a new asset in replacement. So, if the consideration received on the disposal of an old asset used for the purpose of trade is applied in acquiring a new asset in replacement, that is rollover relief. What are the conditions for claiming a rollover relief? Conditions for claiming a rollover relief. Conditions for claiming rollover relief. Number one, the asset disposed of must have generated capital gains. The asset disposed of must have generated capital gains. What does this mean? So, if the asset disposal, if it generated a capital loss, you cannot claim a rollover relief on such assets. That is, if the cost of acquisition is greater than the sales proceed, that means the asset is resulting in a capital loss. In such a case or in such a situation, you cannot claim a rollover relief on that asset. Before you can claim a rollover relief, it must have generated a capital gains. The amount reinvested in the new asset must exceed the cost of the old assets. Number 4. So the amount reinvested in number 3, we say it must exceed the cost of the old asset. So the cost of the old asset must not be greater than the sum reinvested. Number 4, the assets must be of the same class. The asset must be of the same class. They must be of the same class. I've told you that you cannot sell building and utilize the proceeds to acquire equipment and you say you want to claim capital rollover relief. If you sell building, you use the proceeds, you utilize the proceeds of disposal of building to acquire equipment. They are not of the same class. You cannot claim a rollover relief in such a situation. So the assets must be of the same class before you can claim a rollover relief. Format for the computation of capital gains tax with rollover relief. So we have XYZ Limited. Computation of capital gains tax payable for 22x year of assessment. So you start with the sales proceeds. Sales proceeds. From sales proceeds, you less allowable expenses. Less allowable expenses. So you get net sales proceeds. Then you have less cost of acquisition. Cost of acquisition. So then you get capital gains. Capital gains. Then you have rollover relief. Rollover relief. Rollover relief includes, so I've told you that you always start with lower of these two items. Lower of number 1, sales proceeds. You consider the lower of these two items. Then amount reinvested. You consider the lower of these two items. Then from the lower of the two, you now less cost of acquisition. So if you deduct cost of acquisition from the lower, then you get the amount of rollover relief claimable. If you now deduct rollover relief from capital gains, you get chargeable gains. On these chargeable gains, you now apply your tax rate. Capital gains tax payable at 10%. You apply 10% of this, you get the amount of capital gains tax payable. Allowable expenses. Expenses include, allowable expenses include, number 1, we have selling expenses. Selling expenses, e.g., advertisement cost. So that is allowable in capital gains. Number 2, professional cost. Professional costs, such as solicitors' fees, accountant fees, brokerages, estate valuers' fees, estate agent fees, estate agents' commission. All those expenses are allowable. Number 3, we have improvement costs prior to disposal. Improvement costs prior to disposal, or cost of refurbishing the asset, or cost of refurbishing the assets prior to sales. All these expenses are allowable. Cost of acquiring the assets disposed. Cost of acquiring the assets disposed. All these expenses are allowable in capital gains tax computation. Example: White Cleaners Limited is involved in dry cleaning business. The company acquired a building for the business within Shonibare Estate, Maryland, in the year 2011 at a cost of 25 million naira. It also acquired dry cleaning equipment and a generating set at the cost of 5 million naira and 3.5 million naira respectively. The wrong location of the company, coupled with the poor performance of equipment, some of which were refurbished but wrongly believed to be new, resulted in low patronage. The company resolved to make a new start in the year 2013 by selling up everything to use the proceeds to augment the acquisition of new ones. The building was sold for 30 million naira, while the equipment and generating set were sold for 3.5 million and 4.3 million naira respectively. The new building was acquired on Victoria Island for the same business at 65 million naira, while the equipment and new generating sets were acquired for 7.5 million naira and 3 million naira respectively. You are required to compute the capital gains tax payable. B, the costs on which capital allowances will be granted to the company based on newly acquired assets. This question is obtained from ICAN study test, advanced taxation. Now let's have the solution. The name of the entity involved is White Cleaners Limited. White Cleaners Limited. In requirement A, you are required to compute the capital gains tax payable. So you put capital gains tax payable. You have to state the year of assessment. The year of the disposal of chargeable assets is the year of assessment. Now, what is the year of disposal? Company resolved to make a new start in the year 2013 by selling up everything to use the proceeds to augment the acquisition of new ones. The year of disposal is year 2013. So you now put for 2013 year of assessment. 2013 year of assessment. Now, the first assets that were sold, the building was sold for 30 million naira. So now, let's compute capital gain tax on sales of building. Building, we have sales proceeds. Sales proceeds. Building was sold for 30 million naira. It was sold for 30 million naira. We don't have any allowable expenses in this question. So we now less cost of acquisition. As at the time of acquisition of building, how much was the cost of acquiring the building? We were told the company acquired a building for the business within Shonibare Estate, Maryland, in the year 2011 at a cost of 25 million naira. The cost of building is 25 million. So less cost of acquisition, which is 25 million naira. If you deduct 25 million from 30,000, then you'll be left with 5 million naira. This 5 million naira is the capital gain. Capital gain. Then we now deduct rollover relief. Rollover relief, claimable. I've told you that rollover relief, you have to consider the lower of number one, sales proceeds. Sales proceeds, and the sales proceeds amounted to 30 million naira. Then two, amount reinvested. How much was reinvested? You were told a new building was acquired on Victoria Island for the same business at 65 million naira. So the amount invested in new building is 65 million. So we have 65 million. So you are going to choose the lower of these two. So from the lower of the two, you now less cost of acquisition. Less cost of acquisition. The cost of acquisition, as at the time of acquisition of building, it was acquired for 25 million. So if you deduct 25 million, remember we are choosing the lower of these two. The lower of sales proceeds and the amount reinvested. And we are choosing 30 million since it is lower than 65 million. If you subtract 25 million from 30 million, then you will have 5 million. So amount rollover, or you can just put rollover relief. Amount rollover. That is your rollover relief claimable. 30 million minus 25 million. That will be 5 million naira. So if you subtract, you have capital gains of 5 million. If you subtract the rollover relief of 5 million from 5 million, 5 million minus 5 million. So we have chargeable gain. Chargeable gain, that will be nil. At least 5 million minus 5 million, that will be nil. So capital gains tax payable at 10%. 10% of chargeable gain. Since chargeable gain is nil, so capital gains tax payable on building is nil. So after building, what is the second asset that were sold? The second asset that were sold, you were told the building was sold for 30 million. We are done with the sales of building. Why the equipment and generating set were sold for 3.5 million and 4.3 million respectively. So now we want to compute the capital gains tax payable on the sales of the equipment. Now, the second asset is equipment. So we have sales proceeds. So which is 3.5 million naira. 3.5 million naira. The sales proceeds of equipment is 3.5 million. Less cost of acquisition. Since there is no allowable expenses, so less cost of acquisition. As at the time of acquisition of equipment was bought for. So we have, it also acquired dry cleaning equipment and generating sets at the cost of 5 million and 3.5 million. So the cost of equipment is 5 million, while for generating set 3.5 million. So cost of equipment 5 million. So less 5 million being the cost of acquisition of the equipment. If you deduct 5 million from 3.5 million, you have capital loss. Capital loss of 1.5 million naira. It is a loss because the cost of acquisition is greater than the sales proceed of the chargeable asset. So this results in a capital loss. And we have said that where the computation of capital gains resulted in a capital loss, that no rollover relief can be claimed on such asset. So rollover, there will be no rollover relief. But suppose you want to compute rollover relief on this asset, how much will that be the rollover relief? Remember, I've told you that no rollover relief is claimable on equipment since it results in capital loss. And we said rollover relief, we said it is the lower of one, sales proceeds. The sales proceed of equipment is 3.5 million. 3.5 million. Then amount reinvested. How much was reinvested on equipment? So we have, why the equipment and new generating sets were acquired for 7.5 million and 3 million. So the amount invested in equipment is 7.5 million. So we have 7.5 million. So in this case, the lower is 3 million. So that means 3.5 million. That means 3.5 million will be chosen. From the 3.5 million, you deduct cost of acquisition, less cost of acquisition, less cost of acquisition. Remember, I've told you no rollover relief is claimable on equipment since it results in capital loss. So cost of acquisition is 5 million. If you deduct 5 million from 3.5 million, it will still be negative. So no rollover relief is claimable on this. Since no rollover relief is claimable, so capital gain tax payable now on equipment. Capital gains tax payable at 10%. Since this resulted in a capital loss, capital gain tax payable will be nil. The third asset which was disposed is generating set. Now let's have generating set. Sales proceeds. The building was sold for 30 million, while the equipment and generating set were sold for 3.5 million and 4.3 million respectively. The proceeds from sales of generating set is 4.3 million. So we have 4.3 million. From the sales proceeds, we less cost of acquisition, since there is no allowable expenses. So we less cost of acquisition. The only expenses that is allowable is cost of the asset. The cost of generating set is 3.5 million naira. 3.5 million. 3.5 million. If you deduct 3.5 million naira from 4.3 million naira, then you have 800,000. That 800,000 is the capital gains. From the capital gains, you compute your rollover relief. Let's compute our rollover relief. I've told you that to compute the rollover relief, I said the lower of these two items. Lower of number one, sales proceeds. The sales proceeds is 4.3 million. 4.3 million. 2. Amount reinvested. Amount reinvested. You were told a new building was acquired on Victoria Island for the same business at 65 million, while the equipment and new generating sets were acquired for 7.5 million and 3 million. So the amount reinvested in generating set is 3 million. So amount reinvested is 3 million naira. So from these two items, you go for the lower. The lower is 3 million. So that means 3 million will be chosen. So we now less cost of acquisition. Cost of acquisition. So at the time of acquisition of generating set, it was acquired for 3.5 million. 3.5 million. So in this case, the sum invested is lower than the cost of acquisition. Since the cost of acquisition is greater than the sum reinvested, or is greater than the amount reinvested, no rollover relief will be claimable. So since no rollover relief will be claimable, because if you have 3 million minus 3.5 million, it will be minus 500,000. So, you cannot claim rollover relief since the cost of acquisition is greater than the amount reinvested. Therefore, chargeable gain will be the 800,000 naira. So this 800,000 will be our chargeable gain. If the chargeable gains is 800,000, capital gains tax payable at 10%. 10% of 800,000, that will be 80,000 naira. So that is the solution to the A part of the question. The cost on which capital allowances will be granted to the company based on newly acquired assets. If you want to compute capital allowance based on newly acquired assets, it is the sum reinvested that the capital allowance will be computed upon. So for building, the cost upon which capital allowance will be granted is 65 million. For equipment, we have 7.5 million, and for generating set, we have 3 million. So cost on which capital allowances will be granted include for building. Amount reinvested in building is 65 million. For equipment, Some reinvested is 7.5 million. For generating set, we have 3 million. 3 million. That is the solution to the question. In my next video, I will examine partial disposal. I will also consider the treatment of hire purchase in the computation of capital gains tax. Thanks for watching this. Please like the video, share it with others, and subscribe.